Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at AMCR PLC, ticker AMCR. I wanted to take a look at the S&P 500 and find what some of the lower priced stocks on that list were. Viatris was one of them we've taken a look at previously, but this is second on the list for cheapest stocks in the S&P 500 at $9.03 currently, but I'm coming up with a fair value for it of $13.90. So this is definitely an interesting one. They are a consumer packaging company. It looks like just about anything in the grocery store, food-wise, they make containers for. They do also do shipping packaging. And I know personally, I do a lot of shopping online. I've kind of stopped going to the stores in person just because I can evaluate different options and just get it shipped to my door if I don't need it that day. And that's how I do a lot of my shopping. Based on how well Amazon's done, looks like a lot of people do something similar. So that is a pretty bullish case if they're able to pick up on some of that momentum. Earnings-wise, seems really good. Almost 5% earnings yield. What we're paying, we'd want at least 45 cents of EPS. And what we're actually getting this last year was 51. This year, analysts are projecting 73, and next year, 83. They did have a bit of a down year this last year, and if I were to classify it, I'd put it in the group of turnaround stocks. Cash flows are okay, 6% on average, 6.4. So, I mean, it's awesome if they can get it above 10, but really for what they do, it's fine. Dividend yield is super high, 5.53%. Cannot afford that if they don't grow their earnings. So based off their earnings projections for this year, it's looking pretty good. We like 50 to 75%, and they are right within that range based off of the projections for 2025. On average, their dividend yield is 3.76%, so it is, on a dividend basis, also undervalued. Returns, not the best. ROE is the strongest at 18.73%, but that is clearly being swayed by the debt-to-equity ratio of 3.24. So the balance sheet does not seem to be in a good position. And when we go and we take a look at it, it's pretty flat, actually a downtrend in assets and in liabilities. They don't have tangible book value or tangible assets. So it looks like it's a very expensive operation, which helps with their moat because it'd be hard to be a startup in competition with them, have a lot of infrastructure to keep the business running. But gross margins are pretty strong, 19.88 on average, 19.76, almost the 20% that we like to see, completely fine. But the net is a little low, 5.33 on average, 6.3. So they did have a bit of a down year, as I mentioned. I'd like to see that pull back up, and I don't think that they'll have any problem with that, especially with those strong gross margins. Price to earnings ratio of 12.37, which is pretty good. 15 is pretty standard for the industry, and with the earnings growth rate of 13.7, that gives them a price to earnings growth of 0.9, which is below 1, where we like to see it. So earnings definitely undervalued. The dividend shows historically, based on what the market prefers to pay for the stock, it's undervalued. They had a down year. The stock suffered for it. And we can take a look at the pricing history and see over the past few years, I mean, it was around $11 to $12 from 2020 to 2022. And then in the $10 range from 23, 24, and dipped down in 25 to 9.6 for their average open. We can jump right into the thesis to see what analysts are saying and what some future potential for this company is. And to start, in the last 3 years, revenue is only up 2%. In the last 2, it's down 2%. So they had a really good year 3 years ago. And I mean, this is all based off of a bad year this last year. 2024 was only higher than 2021 when we look here historically. But analysts are projecting a really good 2026. As you can see here, 32% in the next 2 years. I'm going to stick with that 10 that they're saying for the next year. That's going to be a recovery over this prior year and maybe some growth on top of that going forward. They do buy back shares, something that we like to see. 2% in the last 3 years, just about 1% in the last 2. I'd like to see them continue at 1%, if not more, if they believe that their stock is undervalued. Insiders are buying quite a bit, and that is a good sign. So someone with skin in the game is purchasing. I think that I would consider putting a portion of my portfolio towards it as well, at least selling puts at the $9 mark. I'd take assignment if it were to go below that, and I wouldn't have an issue because it's well below 30% margin of safety. Assets, they have been selling off 1.3% over the last 3 years, 1.76 over the last 2. So I'm just putting 1.5 for the thesis here, kind of in between those two. Liability is a little different. They grew in the last 3 years, but shrank in the last 2. I'd like to see them continue to shrink it, but on the safer side, we just say it stays flat. Dividend, massive growth over the last 3 years. We can take a look at the chart here. 2021 was super low, and they've just been gradually doing smaller increases. I don't blame them because it is getting pretty high, as I said, based off their EPS this last year. They were pushing it with that dividend. So that 1.3% is completely reasonable. I think 1% would be the minimum that a dividend investor would want to look for here. So again, we're playing it on the safer side. And then margins, 5% growth from where they currently stand takes them up to 6.8 in the next 5 years, which is above what we've seen from them historically. Definitely not the 10% that I'd like to see them at, but again, we're looking for a safer bet here. So this, I feel like, is a pretty conservative estimate. Revenue might be a bit high. That is the lower end of what analysts are projecting, though. So if we agree with them, then we'd be looking at annual growth in the fair value of about 9%, so in line with market returns. But once you factor that dividend in on top of that, you're looking at somewhere in the realm of 14.88%. So super strong returns with that 5% on top of market returns, which is why I would consider buying it, especially with this 30% margin of safety. I mean, if it were to reach its fair value in the next 3 years, you'd be looking at gains of 82%. And that would significantly outperform 3x market returns. And in the next 5 years, if it's able to achieve its fair value, you'd be looking at 129% compared to the market's 47%. We can take a quick look at the prices here and see what we're looking at for how everything is trending. And one thing to note here is just how close the share price has been traditionally with the fair value. They were like right on top of each other back in 2020. A bit of a difference in 2022. I mean, we are talking less than 50 cents, and then about 66 cents in the opposite direction in 2023, and it started to diverge this last year, and there's a huge divergence now. I mean, the only thing that's really down is the balance sheet. They're selling off those assets, and that's definitely not helping them. It's in a pretty poor shape to begin with. But we do see some good things with other factors, like the dividend, really low in 2020. And I mean, that's small growth. It's holding it up there. But it looks like for the dividend you're getting, market's willing to pay around $13 for that. I know personally I'd be willing to pay about $13 for that dividend, as long as the underlying company isn't terrible. Earnings, they yo-yo a lot. It's an up year based on history, so we should see the stock price go up as well, based on how history goes with that too. And PE is what a lot of novice investors use for their fundamental analysis and to decide what stocks to buy. So if they are able to achieve the earnings that the analysts are projecting, which is nearly 50% higher than what they had this year, then you should see a decent jump in the stock. And then cash flows were super strong in 2020 and 2022, bringing in the most value. Had a dip down in 2023 and are on a comeback now. this year they're going to be right in line with the fair value, not too far off the dividend value. So it definitely looks like $12 to $13 is a really fair value for this stock based on its projections for this year and next year. And it's clearly undervalued with where it sits today. So unless you completely disagree with analysts, even if you do, let's say they come in with a 2% growth, that's what we had seen them come in with over the last 3 years, you're still 7% annual growth with 12.6 after you factor in the dividend. If you think the analysts are wrong on the revenues, let's go with the 2% we've seen over the last 3 years, which means we'd probably want the cash flows to come down in line. Average annual growth of 2%, 7.6 after you factor in the dividends. So essentially in line with the lower end of what you would expect from the markets, but the price that you're buying in at, with that margin of safety, you're still outperforming. 2x in the next 3 years, and looks like you're beaten out in the next 5 years. So that is what we are looking at here. My biggest takeaways: clean up that balance sheet. I know this isn't some pretty business where they're going to have incredible returns and margins, but they could have a lot of volume and a lot of revenue. With that and continued share buybacks and dividend growth, I think that this is a reasonable value stock and a turnaround play. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe to stay up to date with everything. And I'll catch you next time.